So on Hot Picks today, we are taking a covered call angle. Covered calls, of course, selling them is an option strategy where you sell an option that gives another investor the right to buy a stock you own at a fixed price. It can be great because you get premium income in, which reduces your cost of owning the stock. Our guest thinks that General Motor is amenable to this strategy. We're joined by Barry Martin, lead portfolio manager at Shelton Equity Income Strategies. Great to see you. And in expensive markets, this comes up, doesn't it? Covered calls, a lot of talk, because it makes it cheaper to own a stock, for one thing.
Yeah, exactly. And thanks for having us on, Andrew. So there's, we're in an expensive market. Another thing, we're seeing a lot of volatility. And so what you can do is take advantage of those two things is basically sell covered calls on underlying equity. So what we're doing is generating additional cash returns by monetizing volatility underlying position, and we do that on specific stocks. And as you mentioned before, a stock like GM.
Why is GM? Maybe we'll put up a 5-year chart for GM. Is there anything in particular about GM that makes it suitable?
Well, GM's got finally we have a stable auto sector. So when you're looking at writing covered calls, I like to look at more of names that have defensive quality, names that generate free cash flow, and also names that actually have performed well. They recently had earnings and performed well, and they're at at near highs, all-time highs. And so what you can do is take advantage of that. So maybe that run has gone a little bit, but what you're doing when you're selling a covered call is, like, for example, a good call to sell on this would be like the December 75s. So if you sell the December 75, someone's going to pay you $1.10 for the right to buy GM off of you in December, which is the third Friday of December, for $75 a share. Now, if GM never gets to $75, you put that $1.10 in your pocket and you can do that strategy again. If it does get to $75, you have a choice. You can let the stock be sold, or you can buy the option back. But the great thing about this trade is that you're right now with the stock at around $70 a share, you get $5 of upside here. So you get the $5 in upside, plus someone's going to give you $1.10. So really, as you mentioned before, you're either reducing your cost basis by $1.10, or you're adding to the proceeds. So you're looking to sell it at $76.10, which is about an 8 to 9% return. So it could be a really nice trade, depending on how it plays out.
CVS Health, it could work for this name as well, do you think?
Yeah, CVS is a little different. It's more of a defensive play, and it's already paying a sizable dividend, over 3%. So if you can sell covered calls on this and maybe generate additional 4 to 5 to 6%, now you're looking at something that's paying 7, 8, 9% on a defensive name. Also a name that's actually done fairly well this year too as well. So it might be the upside might be a little bit limited going forward, but in this case, maybe the November 87s, they have earnings tomorrow, so there's a lot of volatility in there. But if you sell the November 87s, which is in 25 days, someone's going to give you $1.41 for that right to buy CVS off of you at 87. So add that to the 3.5, close to 3.5% dividend yield. It's a pretty attractive trade.
Now, Newmont, you think it could work for that one as well? This is interesting, of course, because gold stocks have been so hot. I know gold has come off its peaks.
Yeah, so this is a little bit of contrarian play because we had the reduction here recently. But this type of this has been our holding in the materials sector, and it's run up so much recently that the stock went into the money. So, for example, we previously had the 80 calls written against it. It went deep into the money. It got close to 100 and came all the way back down. So really dampened that volatility underlying equities. But I think with the volatility in Newmont mining in the underlying equity, you can really take advantage of that and sell covered calls. But that one, once again, I look at the shorter dated, maybe the November 85s, which is 25 days from now. That's paying right now about $1.44. So you get about 8% upside. And then you add that to its dividend yield. It's an attractive play. You're really taking advantage of the volatility.
It's interesting with Newmont. You may have seen that there's talk that they might take a run at Barrick Mining, and or perhaps maybe tried to take over their Nevada operations. And it's interesting. I mean, if the market, if a transaction came along and the market didn't like it, and the stock dropped, that you would at least have your call income to mitigate the loss.
Yeah, exactly. Because in this strategy, again, you're really taking advantage of the volatility, which is also the unknown, and you're selling that vol. I would say, one of the downsides to the strategy is a dramatic appreciation of the underlying equity. You'll get called out of that, and your upside will be capped. But on the flip side, you get a little bit of that cushion for receiving that cash for selling the calls.
We had a guest on just a little while ago who said that, in fact, covered call broadly has become so popular as a strategy.
Oh, yeah.
It's affecting the entire options market and tending to depress premiums because so many people are keen on selling calls.
Yeah, so we're seeing a lot of that on the index place or space where you're selling index calls. There's a lot of people that are structured and that they have a disciplined way of selling calls. We're active. I think it's appropriate to be active on the underlying equity. So we're selling individual calls and individual names where you're seeing a dispersion between the volatility of the single stock names versus the index names. And so I like playing in the individual call space because you get that individual vol and you don't see what's happening in the index space compared to the individual calls. So I think individual calls are still somewhere where it's not depressed, especially now, especially in names like General Motors, CVS, and Newmont Mining. But in S&P calls, it's a little different.
Barry, thank you very much indeed.
Thank you.
Barry Martin, lead portfolio manager at Shelton Equity Income Strategies.